This is Debbie Hotchkins with Elliott Wave International. Last week, Tom Denham, Senior Metals Analyst with EWI, shared his outlook on the gold market with us. Today, we are here with Jim Martens, EWI's Senior Currency Strategist. Jim is editor of our Currency Pro service, which offers intraday along with daily, weekly, and monthly forecasts for the dollar rates, including Euro, Cable, Aussie, Swiss franc, Japanese yen, Canadian dollar, plus the dollar index. For the first time ever, on July 23rd, we are opening the doors to our entire line of pro services for a full week free. You'll have access to our intraday and daily coverage of 48 global markets, including Jim's currency analysis, stocks, metals, energy, and interest rates. Jim, welcome.
Thanks, Debbie. It's a pleasure to be here.
Your subscribers use your analysis to take advantage of opportunities in the currency markets. The euro is probably the most actively traded dollar pair, and it looks like the early May high in the euro was fairly significant. Looking at the chart, there's a wedge-shaped pattern leading into that high. Can you explain what you were anticipating at that time and how subscribers could have used that information?
Debbie, that wedge that you see was critical to our analysis. We've watched the euro climb for quite some time, and when we spotted that wedge, and you can see it by those contracting trend lines shown on the chart, it warned us that the rally was finally running out of momentum. And you can see that each of the legs labeled 1 through 5, each one was shorter than the prior one. So wave 3 was shorter than wave 1, wave 5 was shorter than wave 3. And I mention that because this is critical to the idea that the rally was coming to an end. There's a rule in the wave principle that suggests that wave 3 should not be the shortest of the 3 impulsive waves. That's waves 1, 3, and 5. And in this case, since wave 3 was already shorter than wave 1, we were able to calculate a target that if the rally was coming to an end, that euro dollar should not exceed. And that target lied at 141.88. So we had an upper boundary. And whenever I'm looking for opportunities, before I get involved or get excited about a possible opportunity, I always like to know where the count I'm working would be proven incorrect. And in this case, it was 141.88. So as we were approaching 140, this market all of a sudden looked very interesting to us. We'd been looking for a turn, and it looked like it was ready to finally occur. The other interesting thing about this was the timing. The day the market peaked was a scheduled ECB meeting. And in the statement afterward, ECB President Draghi was talking about euro strength and the drag it was having on their recovery. So the market took that immediately and turned the market around. As you can see at that top bar, which is just pips below 140, it was a dramatic reversal, and that occurred very quickly, probably within an hour of his statement. You could see that market psychology changed drastically. So we looked at that and said, well, that is probably the top. And when we looked very closely at it, within wave 5, you can see it's a 3-wave affair, and we measured where the third leg up would equal the first leg up, and we came up with a target at 140.05. The actual high was 139.93, just 12 pips short of the ideal target. So we were prepared before the meeting ever took place for a turn to the downside, and that's exactly what we see here.
Based on this pattern, what was your target for the euro?
Well, Elliott also tells us, just like it tells us ending diagonals are just that, ending patterns, so warning of a turn. Usually the turns are abrupt, which did occur, and the pattern itself is fully retraced. So before the turn ever took place, we were already looking at where the next decline might go, and the initial target is down where you see the B, the label B, at 132.96, so somewhere around 133, and that is just for starters. That's our initial target. It would retrace that ending diagonal pattern.
If someone didn't get short near the top or in the subsequent days, how would a trader join the downtrend?
Well, let's first start with at the top. We had that initial target up around 141.88, and with the market trading near 140 on the day of an ECB meeting, you'd have to be very aggressive to turn bearish there. But we did have that second target at 140.05. So once the market made that very abrupt turn, that first bar off the high, someone who's quite aggressive might have said, this is an opportunity. We're looking for a downturn. The timing with the meeting is interesting. The market is suddenly changing its mind about the direction of the euro. But if you miss that, and I would think most folks probably would, again, you'd have to be very aggressive to think along those lines. The wave pattern suggests that markets unfold in these patterns, and in the direction of the trend, in this case, the decline is going to unfold in 5 waves. So you can see it here, 1, 2, 3, 4, 5, into the low around 135. So someone might have spotted that wave 2. You know, it's a pause within what we expect is going to be a much larger decline. But to turn bearish there, personally, I would say you'd have to risk all the way back to the high, 190s or 139.93, and that'd be a bit too far for me. Maybe not for everyone, but for me it would have been. So I would have sat back and waited for the completion of an initial 5-wave decline off the high, which we show ending near 135, and used the subsequent reversal. Now, before I talk about the reversal, it's very interesting. In that decline labeled 1, 2, 3, notice that wave 4 is a sideways pattern. We call that a triangle. And it sends a very similar message as that ending diagonal earlier. It tells you that the next move, which should be a sharp thrust in the direction of the recent trend, is the final movement in that. In this case, it's a 5th wave. So you're going to have a sharp move down, we call it a thrust, and then a reversal, so a recovery. And the wave principle goes further and suggests that the 4th wave of 1 lesser degree, again, that's the area of that triangle, may offer resistance. It's interesting, again, because we've advanced on this chart almost a month. Now we're looking at June 5th. And what occurred on June 5th? Another ECB meeting. So going into the meeting and the days leading up to it, recognizing that triangle, we thought that the reaction to whatever statement is made after the meeting would be to sell the euro. And that was the thrust. The reversal, which was extremely sharp, just like at the reversal we saw at the top near 140, that occurred the very same day, and within hours, euro dollar had recovered back all the way above 136.50. I believe it topped the next day where that label A is. So it was during this upward correction that if you wanted to trade the bear side, you were going to look for an opportunity to the downside. But it's a two-way market. So there was another opportunity. First, at the bottom, someone might say, well, this is a thrust from a triangle down and it should be reversed, so someone might have caught that bottom. But strategically, we're expecting a 3-wave recovery, and it should unfold over some time because it took a month for the decline to unfold. So we were waiting for the B-wave setback, which was almost a double bottom, knowing that from near that level there would be a C-wave rally. So I don't usually do this, but at this large degree of trend, there was an opportunity on the bullish side to capture that wave C of 2 that's labeled towards the center of the chart. And that went up, and notice where it topped, above wave A, which was expected, and up against the 38.2% retracement. The wave principle works very well with the Fibonacci retracement calculations that so many people use. And so we had 2 reasons to believe that the market was going to top right around that area, 136.90. And I keep mentioning the ECB. What do you think happened right around the time of that top? That top was on July 1st, and a day or 2 later there was the July ECB meeting. So this market recently, since May at least, has had a habit of making substantial turns on the day or within days of ECB meetings. But that was your opportunity there, that top of wave 2. And again, we're looking for a sizable decline towards 133. So you can see there's plenty of distance to go within this expected decline.
Let's move on a little bit and see what happened after that.
Well, we can pick it up at that wave 2 high. That's in the upper left. And you can see there again, another 5-wave decline. You have to remember, in the direction of the trend, these waves unfold in 5s, just as is shown here, and just as we showed off of the 140 high. They are repeating patterns, and that's what I like about the wave principle. There's a catalog of a limited number of patterns that we're trying to identify. So in this case, if you missed the wave 2 in the upper left, that high near 137, there was an opportunity later, and that might be just off the high. There was a decline labeled wave 1 in parentheses, and then a very nice 3-wave rebound in wave 2. Now, I've mentioned that in the direction of the trend, the market unfolds in 5 waves. Counter trend movements, corrections, unfold in 3 waves, and that wave 2 is a nice example of one. So at that point, with the market trading near 136.60 on the rebound, knowing that the prior correction, the wave 2, ended at 137, you knew we were wrong. We can lower our risk levels all the way down to 137 now. So we're looking for rebounds as bearish opportunities using now that 137. So there was one there. And then the market continued lower to finish that 5-wave decline. If you missed that opportunity, there was yet another. Remember, this is fractal. Now we finished wave 1 of 3, so we're looking for a rebound in wave 2. So the 2 in the circle represents that recovery. And it looks like a mess, doesn't it? It's just overlapping, wave after wave of overlapping. Compare that to the prior decline. Notice how sharp it is. The wave 3 is a vertical line right in the middle. You don't see that action during this recovery. So I classified it as a correction, which is what I expected, and I counted it as a double zigzag. That's a bit complicated for what we're doing here today, but it is a corrective pattern. All it does is connect 2 3-wave movements. But it certainly does look corrective. So as the market approached 136, someone would look at, say, well, where's the risk? It's at 137. So can I risk 50 pips or thereabouts? And my target is still around 133 on the downside. So with it trading at 136.50, we're talking about maybe 350 pips of reward against 50 pips of risk. So perhaps that was an opportunity for someone. But again, the point being, we knew we were wrong before we ever got involved.
Jim, how did you anticipate the end of that correction that you have labeled as red circled wave 2 at 136.50?
Right. You could have done it just based on that risk reward of that 50 pip risk. But there was the 618 retracement. Again, I mentioned earlier the Fibonacci retracements. The 2 most popular are the 38.2% and then the 61.8%. And notice that in addition to the corrective structure of the recovery, it ended just a pip or 2 short of that upper Fibonacci target. So it's the combination of the 2 events, the corrective structure of the rise, which is most important, followed secondly by the proximity of the 618 retracement. But most importantly, where was it wrong at 137? So it told you you're very close, likely very close to the end of this recovery. It may be a time to act.
Were there any other opportunities after that point that you would have suggested?
I continue to take the same approach. From that wave 2 in the center of the chart, there was a sharp decline, wave 1. Notice there's no overlaps within it like the prior recovery. It's sharp. And it was followed by another 3-wave rise. Now this one's a bit deep. It's beyond the 618. So again, it's important to recognize the structure of the recovery. It's overlapping, which means it's likely corrective. You also know where if you're bearish, you're going to be wrong. If it's a correction, it shouldn't go above 136.51. That's the larger degree wave 2, the circle 2 in the middle of the chart. So in this case, as it approached 136.40, so maybe it was 136.30 or 35, you knew you were wrong at 136.51, you could have looked at that and said, given the minimal risk and giving the outlook for a return to 130 to the 133 area at least, here was yet another opportunity. And that's what's so great about the wave principle. If you miss one opportunity, as these waves unfold, there's likely to be others along the way. And this chart shows it perfectly. We had the wave 2 in parentheses in the upper left. If you missed that, there was the wave 2 just to the right. If you missed that, you rode the decline all the way down, and then there was the wave 2 in a circle. If you missed that one, then you had the 1, 2 we just spoke about. This chart alone shows a number of opportunities. You could have taken advantage of one or all of them. So there were plenty of opportunities in this market, which continues to unfold. You can see that sharp decline that followed, just as we'd expect if a third of third wave is unfolding.
Jim, some news came out this morning, and the euro did have quite a nice move. I went ahead and pulled your chart from the intraday analysis that you just posted a little while ago. Could you tell us a little bit about how this fits into your outlook?
It fits perfectly into what we're expecting. First of all, from that wave 2 in parentheses, just to the left of center, you see a sharp decline, which we've labeled 1, 2, 3, 4, 5. So again, when we're using numbers and counting 5 waves, that's in the direction of the trend. So it helps me gain confidence in the idea that the larger trend of this market is downward towards that 133 target that we talked about earlier. Another interesting thing on this, which was so important this morning, is once wave 3 bottomed, notice that we went sideways in wave 4. And we've seen this triangle before. It's a triangle. And again, triangles unfold as the movement before the final movement in the trend. In this case is a fourth. The fifth wave being a thrust, we had a sharp move down, and we already suspected that we would get that sharp move, but we already knew that it would be reversed. So the market's setting up here for yet another correction, and the chart already shows the possible objectives, the 38.2% retracement and the 618 retracement. So the action this morning, even though now we're expecting recovery, it is in line with our larger bearish outlook. So everything, as far as we can tell, the market is telling us that to this point we're on the right side of the market, and this recovery is likely to present yet another bearish opportunity.
I like that you're always looking for additional opportunities within the moves on the charts, and that you're also keenly aware of where your analysis is wrong and where you should get out of a trade. Thanks for your time today, Jim.
Thank you, Debbie.
Be sure to join us for the Pro Services Open House, July 23rd to 30, using the link below this video. Registration is limited, so be sure to sign up today. When you sign up, you'll get immediate access to educational resources about Elliott Wave analysis, resources that will help you get ready for Open House Week. You'll also be able to watch my interview with Tom Denham on the gold market. Happy trading.